Hello everybody and welcome to this new video. So in this new video I'm going to talk about the incoming fintech revolution. Legacy finance is still getting disrupted. Despite the fact that stocks have crashed, especially in the fintech field by 80 to 95%. I think this is entirely warranted because disruption is happening. And right now we are thinking short term and people are bidding up the banks because they think rates going up is a good thing, but it's not. It's probably not what is going to happen. Not investment advice. So today I hope to show you some of the stocks that I'm buying and why I think what's happening in the fintech world right now is very similar to the dot com crash. Uh, in fact, if you go back to the dot-com crash, sure, some companies lost everything, right? They went out of business like pets.com and Webvan, and I'm sure some of our fintech stocks of today will go bankrupt, just like we've seen in the crypto space with so many companies actually going bankrupt recently or the past week. But others will make it. Others will 100x. And the problem is that we don't know which ones. But if you look at what happened since the dot-com crash, you see that tremendous companies like eBay, Oracle, Intuit, ASML, Adobe, Amazon, Priceline, now Booking, all crashed 80 to 90%. They were left for dead. Even Apple crashed. Apple was not created in that era, but even Apple crashed. Like all these companies were left for dead. And of course, today they are the world's largest companies. So let's not panic. And I guess I'm not panicking because when you look at the facts and when you look at the long-term facts, you realize that legacy finance is in trouble. Most banks have a bloated structures. That has been for many of them 100 years, more than 100 years in the making. Like look at JP Morgan, look at Wells Fargo, how old these companies are. That's why they have hundreds of thousands of employees. That's why they have more than a dozen layers of management. That's why they're not agile. That's why you still can't buy any Bitcoin on them, even though Millennials and Gen Z have spoken they want Bitcoin. And they're not offering them that. Like it doesn't matter whether we agree or not with Bitcoin, it's what your customers want, and you're not offering it to your customers. The banking business is all about the next generation and onboarding the next generation. It's always been like that. That's how you justify paying up to $1,000 to get someone to switch your account to you. That's how they've always justified it. It's all about the next generation. Because as your customers get older and spend their money in their golden years, they then get replaced and that money goes on to the next generation. So that's why narratives such as, and I've heard that a lot in the people criticizing fitness. Oh, Schwab's overage account is $300,000, and then cue in a laugh. Robinhood is only $2,000. That's a flawed analysis. The average age and the growth is what matters. The fact that Robinhood is growing so fast and legacy finance is not growing at all is concerning. That is not a matter for laughing. Uh, they are not recruiting the customers of tomorrow. Like strategy is about a long-term business. You have to think long-term. You need to skate where the puck is going, right? And it's not going towards more branches. It's not going towards more personalized advice, sit face to face with someone who tells you legally constrained advice, right? It's not how it is. Where the puck is going is self-serve finance, where your Gen Z, your millennials want to do everything on their own. There's a clear way where the puck is going, and it's not where it's been. It's not where it's been, and fintech revolution is addressing that, right? So what do I have to say about the current majority and serving the current majority? Well, it's great. You're making money now. You're paying dividends now. But growth is behind you because Gen Z and millennials will soon be the majority. They will. And just like baby boomers replaced the silent generation, Gen Z and millennials will replace the baby boomers. And it's just the way it is. And so if we want to invest in stocks in say our 20s, our 30s, and we want these stocks to create great returns for the next 30 years, we have to buy stocks that are going to be the leaders in the next 30 years, not those that are going to have huge liabilities and a structure that they can't change, not those that are going to have huge friction. So we need to not invest in the current leaders of today, but in the current leaders of tomorrow. And when I hear people say, oh, XYZ bank has an average account of this much, and then you criticize, say, Cash App for having direct deposits of $1,000, well, you're not understanding. I mean, not saying in general, but if one says that, it's not understanding about the future. The future is about how the money is flowing, right? So the money is flowing. So retirees, first of all, there's a few things they can do with their money. They can spend it, and then it is flowing once again to the newer generation who are of working age. They can transfer it to Gen Z and Millennials, and we know that a lot of baby boomer generation are doing that in droves, because there is a human tendency to love your kids and your grandkids. It's just the way it works. I mean, money flows from generation to generation. So if you're not focusing on the next generation, you are not targeting the growth that you need. And then inheritance. If you don't spend everything, we have a system of inheritance. So the money flows to customers that are going to be customers of other banks, of new banks who are going to be moving money. So you need to make sure, as a legacy finance institution, you need to make sure that you're recruiting Gen Z and Millennials. And they're not doing that. And I think this is a major problem. So what are some of the major wants of Gen Z and Millennials? What do they want? Well, they want everything done quickly in the app. Everything has to be done in the app. We live in a generation where people don't like to speak on the phone. We live in a generation where people want an app and everything done in a super app. Even websites are outdated. It's like the new generation wants everything done quickly, seamlessly in a super app. They want limited interaction. That's how you explain so many companies in the cloud thriving on cloud conversations and conversation with chat boxes. They have no reason to go to a branch. If you do everything digital, you have no reason to go to a branch. I mean, this is so obvious, right? They want low to no fees. They don't like fees. And they don't like fees because they know that technology is flat. They know that technology is scalable, and they don't want to be paying for the banking structure of the past, right? They very much dislike credit cards. That's what Gen Z are telling us. And fees in general. They don't like those. They want something new. And they don't do bonds. They don't do gold. They're interested in a new asset class called Bitcoin/crypto. And again, it doesn't matter whether we like or not that new asset class. That is what they are very interested in. If you look at who owns crypto, it is Gen Z and Millennials. It is what they are interested in. So what if there were companies capable of answering to these needs of the next generation, which are needed for growth? You need to respond to this demand in order to get growth. So what if there only was a few companies that could meet that? Well, here are some of my favorite companies that meet that are US-centric, and I know there's a lot of fintech in Europe, in emerging markets. I'm only focusing on US-centric, customer-facing fintechs and solutions in place. And I know there's also a lot of fintechs that operate in the back end, like Marqeta, for example, but I'm not going to cover that in here. So US-centric, customer-facing fintechs that adopt the business models that are preferred by Millennials and Gen Z. What are they? Again, none of those that I'm going to briefly discuss are investment advice. And some are fairly binary, but mostly one, which is Upstart, which I think Upstart is one of the riskier bets here. But I'll briefly talk about Upstart. So if you like this video so far, please like and subscribe if you enjoy it. And please tell me in the comment which company you would like me to cover in depth next, because I'm going to cover quite a few companies and one new asset, which is Bitcoin. So what is the first company that I think has a big shot in this new fintech revolution? And that company is SoFi. So SoFi is an actual bank. They got their bank charter, was it 8 months ago? They're an actual bank and an infrastructure provider. So they used to just be a technology platform and to outsource everything to an actual bank. But no, this time they bought a bank. So they are the bank. It's a bank experiencing hypergrowth. Okay. It's an actual bank that is operated like a tech company. The CEO speaks the tech world, hires in tech, operates in tech, is agile like a tech company. They have Galileo, which has been dubbed the AWS, Amazon Web Services of FinTech, which powers the services of so many of the FinTechs that we all know of, like Robinhood and Chime. Like they do the back end, they do the credit cards, they do the debit, they do the checking account, they do the savings account. They provide all of this technology to so many of the different fintechs. And this is like a list of all of the fintechs for which Galileo provides services. And Galileo is owned by SoFi. That's actually one of the big theses of owning is SoFi, of owning SoFi. SoFi itself is growing at 50% year over year for just about every single metric. Okay. And they have no branch. So they have no liability. They have no structural debt of any kind. Right. And they have a super app. They have a super app where everything is done in the super app. Checking accounts, stocks, Bitcoin and crypto, loans, cards, career advice, options very shortly. They're going to launch that. Credit cards, debit cards. They have everything done in one super app. Just like the Millennials and the Gen Z want. And I want to quickly emphasize, one may say that it's a problem, for example, that they don't have branches. Like, what if you have physical cash? Well, first of all, it's very rare today that you would have physical cash. I mean, unless you have like a garage sale or something. But if you do, that's okay, because the way companies like SoFi or Square, the way fintechs do that is they partner with CVS and Walgreens. And you can just walk in CVS and Walgreens with cash, and they'll deposit the cash on your SoFi account, right? And if you need cash, physical cash, you don't need a huge, very expensive network of branches. No, SoFi just allows you a few withdrawals of cash at random ATMs, and they'll cover those fees a few times a month. So again, cash is not a problem. It's not a limiting factor anymore. Not having branches are a plus. Not having a branch is a huge plus. Not a limiting factor. And so that is a big deal, especially if you take into account that the digitally native generation doesn't want to talk on the phone, doesn't want to meet in person. They want to do everything digitally. And SoFi, I think, as one of the best shots at becoming the fintech for the higher end consumer. SoFi is really going after higher income folks, like people making more than 100,000. If you read their annual reports, the way who they target, who they finance, it's college educated. That's why they have a little bit of a more sophisticated super app. I would argue SoFi has a more sophisticated super app, which is why they're offering options within a few months. Now, at the other end of the spectrum, so the more entry level super app, I'm just starting my life, my first job at 16 years old. There is another company that focuses on this other segment of a population, which is obviously even bigger, and that is Block, formerly known as Square. And by Block, I mean especially the Cash App. So one of the main reasons why you would invest in Block, I believe, is because of the Cash App. I mean, Square payments are great, they're fine, and we're growing at about 30% a year, which is fine. But Square has competition, etc., etc. That's not the payment system for shops is the icing on the cake, but that's not the reason why I am a shareholder in Block, not investment advice. I am a shareholder in Block because of Cash App. The Cash App, okay, this is me maybe exaggerating, but I don't think so. They essentially crushed Venmo. Venmo is not the main app that people use anymore. Cash App, as I think, I think is much bigger than Venmo, at least in the Gen Z and the millennial consumer, at least where it's headed. And Cash App is growing at about 50% a year. So that is very, very impressive growth. And one of the amazing things about Cash App is that the customer acquisition of a Cash App user is $10. Like banks pay well over 1,000 to acquire a customer, and it's only $10 for Cash App. And okay, I understand everything. Sure, it's not the same consumer. It's not the same. It's not the same. Well, yes, but if a bank recruits a consumer that is 18 years old, I would argue those two consumers are probably very, very similar. So Cash App is more basic, less features, less of it's a simpler super app, but you can still do the main stuff. You can still do it's a competitor to SoFi in the lower income customer segment, and you can still do the same stuff, right? You can do checking account, savings account, debit card, stocks, and Bitcoin all in one app. All in one app. And again, that's disruptive. That's very disruptive to traditional banks who still don't have Bitcoin. Like I don't know what's going on as a traditional bank if you don't offer Bitcoin. I mean, I do not understand what's going on. Like Gen Z and Millennials are saying it so loud and so clear that they want Bitcoin, even with the crash right now. Even with the crash, it is an asset class that is benefiting from huge network effects. So, anyways, speaking and talking is one thing, but I think what's more important is looking at the numbers. In 2018, Cash App essentially had nothing. It was very small, and now they have 51.5 million monthly active users. That's huge. That's tremendous. 51 million monthly active users. That's a lot. They have 18 million monthly active users swiping their debit card. That's a lot too. 18 million monthly active users swiping their debit card. I mean, keep in mind, 5 years ago, Cash App essentially didn't exist. I mean, they're bigger than very famous banks already. It's crazy. I mean, it's crazy. And they have 2 million, and this is what they're pushing hard right now. They have 2 million direct deposit users in September. So in September, 2 million users were doing direct deposit with Cash App, growing at 65% year over year. So again, imagine this compounding. This is compounding, right? I mean, what if you do another 50%, another 50%, another 50%? These companies are going to become behemoths. Behemoths. And we can see the playbook. China has shown us the playbook on this. When you look at what's going on with WeChat and Alipay, these super apps, there will be a super app at some point for finance in the US, and that app will be of a tremendous size. And so, is it going to be SoFi? Is it going to be Block? Is it going to be a mix of both? I don't know who's going to be the super app, but there's going to be a super app. And that's I think where a lot of people are going to do their banking. When you look at these numbers, just to give you an idea, Chase has only 66 million accounts. And Chase is the largest bank in the world. And of course, I understand that the customers of Cash App are not comparable right now. Right now, the customers of Cash App are nothing compared to the customers of Chase because the legacy system is obviously very, very big. But it's all about the growth. It's all about a question of growth and how fast can you grow and how profitably can you grow. There's less than 8,000 people that work in the entire company that is Block, which includes Square Payments, which hires the bulk of the people, the Cash App, an audio streaming device, and a bunch of research into the future of payments. So it's kind of like the efficiency is not even comparable. When you have 202,000 employees, for example, for Chase, I mean, it's not even comparable. The level of efficiency, the operating leverage that whichever app wins this market are going to have operating leverage that are going to be insane, absolutely insane. So I'm very bullish on SoFi and Square, and I think they could both win. With Square focusing on the lower income segment of the market, and SoFi focusing on the higher income segment of the market. Not investment advice, of course, but it only takes one. It only takes a 100x to justify so many wrong investments. So again, I'm just putting that out there, and I don't think I think most of these companies, except maybe Upstart, I think most of these companies are going to succeed. Not investment advice. Okay, let me move on. Affirm and Upstart. Affirm is the modern day response to the Gen Z and Millennials hate of credit cards. If you study popular culture and look at popular culture, there is a general dislike and hate of credit cards by Gen Z and Millennials. They do not like those, and so I don't know what are the underlying psychological reason. It doesn't really matter. But the market is showing us one thing that they really really like, and it's buy now, pay later. And so that is why I think Affirm is really really a wonderful company, because they are both Walmart's and Amazon's choice. Like you can buy at Walmart.com, you can buy with Affirm, and you can buy on Amazon.com with Affirm. So this is a major shift as to how this world of pay later is getting disrupted. Like it's a major shift because millennials want clear understanding of the cost of borrowing and how many payments they're going to have to make. And I think they made it very clear that they don't like revolving credit, that they don't like penalty APYs or fees. And I really think BNPL, which was mostly pioneered by Affirm, is the 0 to 1 move in the space. It is to the new generation of consumers, to where the puck is going. It is a better way to do credit. So I think that's getting disrupted, and the numbers speak for themselves. And so of course the market is saying, "Oh, this is a fad. This is not here to stay," because of course the numbers are still very small in comparison to the credit card legacy business. But I do believe this is a big deal. So I'm a shareholder in Affirm. I like Affirm, not investment advice. Upstart. So I am not invested in Upstart at this point, but I've been following it for a while. I've been following for it for a while. And what is Upstart? Well, they aim to disrupt the credit score market and to replace eventually the credit score with AI, with artificial intelligence. So right now they still use credit score, and they say, "Oh, you are more than your credit score." That's their trademark. You're more than just a credit score, and so they look at both your credit score and their AI factors in order to give you better loans with better interest rates. Um, and I think this is riskier right now, especially because they've put a lot of loans in their balance sheet because of the rise in interest rate that we're seeing, and so a lot of the legacy buyers of these loans, securitized loans, did not show up to buy the loans, and so it's a little bit of a riskier bet right now. Um, but again, it's if they could, I mean, if they could disrupt credit score, think about it. The three main rating agencies are huge. Like this is disruption. This is true disruption, and I think this is really solving a problem. And again, millennials and Gen Z, I do not think they hold credit scores high in their heart. I don't. I just don't. So let me move on to the last slide of this video, which is Coinbase. So as we all know, there's a new asset class in town, and there hasn't been a new asset class in over a century. There is a new asset class, and a lot of people criticize it. Of course, it's one of the perks of being new. You get criticized heavily, heavily, heavily. But the innovation is real nonetheless. It's still a new asset class, and so regardless of whether you want to buy the first true blockchain, which was Bitcoin, and so Bitcoin is like a commodity, or treated like a commodity, recognized as a commodity by most entities in the world. So that's the one asset that you could buy on these payment rails. Whether you want to use currencies like USDC, which by the way, Coinbase has a huge play in USDC. So whether you want to own currencies, right, uh, um, like USDC or like other stable coins, or whether you want to use tokenized securities, and this is like the big debate right now, which is like all of the issues that we've seen recently with the FTX collapse and the FTT collapse. It has a lot to do with the fact that those tokens are securities. They are stocks trading on the blockchain without any of the SEC requirements to make sure that actually there's something tangible behind the stock. So that's why right now it's a lot of turmoil. But they'll fix that eventually. They'll fix that eventually. And so if down the road we trade our commodities, such as Bitcoin, our currencies, such as USDC or Euro SDC, Euro currencies, anyway, whatever stablecoin, and we trade our tokenized securities. So you can have a stock, right? You can entirely see a stock getting traded as a token in the future. And I could go on because there's a whole over sorts of asset class held on blockchains. Like for example, NFTs. Will NFTs be a thing? I don't know. Will collectibles be a thing? Will real estate ever be tokenized? I don't know. But anything that is traded on blockchains is going to have to be traded somewhere on an exchange. So that's why these exchanges are a big part of this thesis. It's like when you invest in an exchange, you don't have to pick. You don't have to pick the winner or the loser. You're betting on the ecosystem. So you're betting on the exchange. And again, we've seen all of these exchanges collapse recently. And one of them that again is a much safer exchange is Coinbase. Coinbase has seen waves and waves and waves of this crazy, still unregulated crypto market, and they are well backed, and they are also recognized by institutions. Institutions love Coinbase and go through Coinbase. So Coinbase can be thought as in my opinion, the safest yet agreeably the most expensive option to trade these new assets. So safest, but also most expensive. But also the bridge between the traditional system and this new system of securities trading on blockchain, of tokens, commodities trading on blockchain. They can act as the bridge. And the more you see some of these other exchanges like FTX fall, the more you see those fall, the more people realize that actually being highly trusted is very, very important. So Coinbase, as much as people hate Coinbase, it is still nonetheless the most trusted. And so how many exchanges are going to be left? Who knows? Who knows? And again, a lot of people also say that DEXs, right, decentralized exchanges, could be a threat to Coinbase, but it doesn't change the fact that you need to get into the ecosystem in the first place. So how do you get into the ecosystem in the first place? Well, you have to go through a player like Coinbase. So I think this is a good play. Not investment advice, but I think this is a good play, especially given how down they are right now. I mean, the stock is so down; it's ridiculous. This company has made a lot of money whenever volatility is there. Volatility fuels this company revenue. It's like a toll. It's like a toll on the whole crypto industry, crypto and Bitcoin, which are different. But I might get that into a different video. And then lastly, Bitcoin period, which is you can buy all of these stocks, not investment advice, but that's a good bet on fintech. Buying all of these stocks is a good bet on fintech. But I also think Bitcoin is a good bet because Bitcoin is really going after the bonds and the gold market, in my opinion. Bitcoin could be bigger than bonds and bigger than gold, because it really is. It really is. Well, first of all, it's what millennials are drawn to. So you're going to have network effects from people wanting to buy Bitcoin, but it also has some of the features that gold has, for example. It's the rarest deflationary token. It's a very rare token. It's very hard to mine. It's very hard to get. It is a new way to save money. It's a mix. It's a mix between Bitcoin is a. And again, this is my first time I talk about Bitcoin on this channel, and I have a lot of thoughts about Bitcoin. So let me know if you want me to talk about Bitcoin. But Bitcoin is a mix between a technology. So you're going to have network effects. You're going to have branding. So it's a mix between an open source technology. It's a mix between a commodity in the sense that gold, like there is a limit in how much Bitcoin can ever be mined, right? 21 million. But then it's deflationary too, because people lose their Bitcoin and they lose their keys. So there's actually only, I think, 14 million Bitcoins that will ever be available if people dare to stop losing their keys. So it's deflationary. It's hard to mine. It has the same features that gold has from that standpoint. And then it is a disruptor of bonds, because when you own Bitcoin, unlike when you own the other main form of savings technology, which is bonds, right? And I mean, you could have cash on the bank account, but cash on the bank account is only insured by FDIC up to $250,000. So cash is really not. You can't save in a savings account because you don't have that insurance. So it disrupts bonds too, because unlike bonds, bonds have counterparty risk. There's huge counterparty risk in bonds. You have no counterparty risk in Bitcoin, and you can actually hold Bitcoin without counterparty risk. So the best analogy that I have is it's as if you were saving huge amounts of cash, right? But you can't save huge amount of cash because it's very, very dangerous to save huge amount of cash. Like if you had $1 million of cash at your house, I mean, you could not sleep at night because someone could steal it. And so Bitcoin removes the counterparty risk that we need to have in the modern banking system, where we need to give money to the banks and then get an IOU, right? It removes that because it allows you to self-custody your savings in your head through a string of 12 words. So it's really, there's really these three main arguments for Bitcoin, and there's many, many more, and that's why there's entire books, entire fields of study, entire YouTubers about Bitcoin. Bitcoin is a very, very deep topic, and I hope to talk about Bitcoin because it is the main new asset in this new asset class. It is the main new asset in this new asset class, and I think Gen Z and Millennials intuitively understand it much, much, much more than legacy finance, which is why legacy finance still doesn't offer it. And of course, the fintech that I talk about, be them SoFi or Square, offer it. So, anyways, and Bitcoin, by the way, is my second biggest position after Tesla. So, none of this has been investment advice. Thank you so much for watching my channel. Please tell me which topic you think I should cover first out of all of these. I want to cover all of these, but tell me which one I should cover first. Don't forget to like and subscribe, and follow me on Twitter. I really appreciate it, and hope to have a lot of threads in the future. So thank you so much, and have a great day.